According to sources acquainted with the situation, several of the major companies in the field, including platforms Binance and FTX, are interested in buying Voyager Digital, the lender whose bankruptcy intensified last year's crypto market turmoil. Welcome to Crypto Inquiry, where we are dedicated to providing you, the investor, and the crypto curious with factual information and topics. Our goal is to keep you informed to make educated and timely decisions and remove the fog of hidden information. Nothing is meant as financial advice, and always do your own research before investing. Here, we are building a community to help each other stay informed and make the most of our financial gains. American exchange Coinbase considered a deal but withdrew, according to one source. Voyager's bankruptcy case is being used to conduct an auction of its assets, and the deadline for bids is September 6th. If an auction is required to choose a winner, it will take place on September 29th. Following the story's publication on CoinDesk, Voyager, the native coin of Voyager Digital, increased more than 40%, according to CoinMarketCap. At least 22 investors have conducted due diligence and shown interest in competing for Voyager's assets, according to a briefing by the company's lawyers. So Binance, FTX, and Coinbase are probably not the only bidders. Industry insiders have heard that Binance, the biggest cryptocurrency exchange in the world, is interested in buying Voyager. Binance is eager and aggressively pursuing. A spokeswoman for Binance said that they have a policy to only reveal agreements when they are finalized and would not confirm or deny any possible deals. Voyager and Celsius Network, another insolvent cryptocurrency lender, approached Binance CEO Changpeng Zhao's business to explore selling assets, he claimed in an interview. According to a source with intimate knowledge of the cryptocurrency's exchange plans, FTX, which made a public offer that Voyager's attorneys rejected, is still in the race. Possible cooperation between Coinbase and Callaway Capital Management, a company located in Washington, D.C. that specialized in distressed properties, was the nature of Coinbase's engagement. A person with first-hand knowledge of the company's reasoning claims that Coinbase, the largest U.S. crypto exchange, looked into a potential restructuring plan for Voyager, but abandoned it after determining that the financials don't add up. Senator from Texas Ted Cruz has claimed that Bitcoin mining provides additional environmental benefits, allaying long-standing worries about the asset's energy usage. Cruz claimed in an interview that Bitcoin mining is net positive for the environment, particularly if miners concentrate on harnessing renewable energy sources. Cruz made an interesting claim, arguing that because Bitcoin miners fosters entrepreneurship, it benefits participating families financially. Cruz noted that in response to criticism of Bitcoin's mining, the practice may coexist with other energy-intensive activities by sharing the grid. He noted the ability of Bitcoin mining to instantly flip on or off creates the capability to instantly move that energy to put it up on the grid in the event of a power shortage or crisis, whether it be a freeze or any other natural disaster when the power generating capacity is reduced. Texas was mentioned by the congressman as the perfect site for developing Bitcoin mining. Cruz claims that in Texas, Bitcoin mining might significantly contribute to fortifying and hardening the grid's resiliency. Notably, the state of Texas has implemented policies to aid and entice Bitcoin miners by implementing a system that compensates operators to half the operation in the event of heavy power demand. Some miners have publicly said that they made significant profits by stopping work during the heat wave. Overall, the United States has become the most popular location for cryptocurrency miners. For the purpose of reducing the carbon footprint of the asset, some states are enticing miners with renewable resources. Charles Hoskinson, the founder of Cardano, claims the U.S. government's decision to ban Tornado Cash creates a risky regulatory precedent. The U.S. Treasury Department forbade Americans from using the cryptocurrency mixing service earlier this month, citing worries about national security. According to the government, the system has been used to smuggle $7 billion in cryptocurrency assets since 2019. Hoskinson warns his 315,000 YouTube fans in a new video update that penalizing code because it's being misused would constitute an infringement on their right to free expression. The convention in developer awareness is that when developers create code, they are writing expressions. It's similar to authoring a book as long as they don't become involved with the execution or application of that code. In a free society, we often permit individuals to act in this manner, so it is quite unsettling when they begin to object. Hoskinson says that since the creator of Tornado Cash never used it himself or instructed others on how to use it, authorities went too far in sanctioning it. Basically, they are asserting that software developers are accountable for how their software is used, regardless of whether they can control that or not, which is an extremely dangerous precedent. He argued that, as an extreme case, the developers of the Linux kernel are designing the operating system kernel. North Korea might utilize the kernel to create a custom operating system that would be used as an ICBM's operating system. Therefore, it is conceivable to claim that the Linux kernel maintainers are assisting North Korea's development of nuclear weapons. If you wanted to, you could say that. That is simply absurd. However, the same legal framework that would theoretically enable you to assign responsibility to the Tornado Cash programmer, even if they weren't engaged in the usage or operation of the system, only writing the code, presents a problem. Some cryptocurrency enthusiasts said that the August 11th announcement by Blackrock, the largest asset management in the world, to introduce a private Bitcoin trust for its customers may legitimize the virtual currency in the eyes of more established investors. With its new private trust, BlackRock will be able to provide Bitcoin to its corporate clients, track its performance, provide direct access to its price, and of course, engage in options trading. Despite the steep downturn in the digital asset market, we are still seeing substantial interest from some institutional clients in how to efficiently and cost-effectively access these assets using our technology and product capabilities, BlackRock said in its press release. The announcement of the cooperation with Coinbase to give users of the Aladdin platform access to Bitcoin trading and escrow services came shortly after the company made that announcement. These developments demonstrate how conventional investors and organizations like banks and hedge funds are entering the cryptocurrency market, proving the long-term viability of digital assets. These recent endorsements provide cryptocurrencies an even greater sense of legitimacy, integrating them into the more established financial sector and so enhancing accessibility for both new and experienced investors. But does support from a large investment management company go against what Bitcoin was intended to stand for? Especially considering that Larry Fink, CEO of BlackRock, referred to Bitcoin as an index of money laundering just 5 years ago. In 2009, the chaotic emergence of Bitcoin signaled the possible democratization of finance. A more transparent and safe approach to cash for everybody was promised by blockchain technology. Has the top cryptocurrency abandoned its revolutionary beginnings now that it is popular in Wall Street investment portfolios? Online doubters believe BlackRock's cooperation with the once top of its game Coinbase is a little more than a power grab by a controlled financial institution because Coinbase stocks are still down 75% from their peak. The governing board of the Federal Reserve has announced rules that would regulate master account requests from organizations with new charters, including cryptocurrency custodial banks and associated trade associations. Institutions can access the payment systems of the Federal Reserve directly through Reserve Bank master accounts. Firms must collaborate with associated banks that hold master accounts without this access. Since many years ago, a number of U.S.-based crypto custodial banks have pushed for full master bank access and look eager to dispense with the necessity of intermediate agreements with traditional banks. The updated regulations do not have the force of law, but they do seem to give master account access-seeking crypto players plenty of leeways. In the complete document, there was just one explicit reference to cryptography. The Federal Reserve has made it apparent that its board does not consider that it is fair to categorically bar all innovative licenses from accessibility to accounts and services, so there may be some cause for celebration within the American crypto community. However, for crypto companies, obtaining master accounts access is not going to be a straightforward procedure. The regulations direct reserve banks to include, to the greatest degree feasible, the evaluations of an institution made by state and federal regulators into their own unbiased evaluation of the risk profile of an application. Michelle Bowman, the governor of the Federal Reserve, added some cautionary remarks in a statement she made on the subject. Bowman expressed caution, saying that while the guidelines would bring consistency and transparency to the process, they were only the first step in that direction. She also gave the impression that the Federal Reserve and reserve banks would take their time processing applications from the cryptocurrency industry. Well, that's a wrap on this video. So what do you think about the crypto winter and its expected end? Be sure to let us know in the comments below.